In this video, we're going to talk about Progenity, trading under the ticker symbol PROG. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. Those are prepared, recorded on the day before, and scheduled for the next day. If there are significant and volatile movements during the trading day, they will not be reflected in the video itself. With that being said, to the extent possible, my analysis will be based on the medium term, or even the long term, and not necessarily on the intraday movements. The main reason why it shouldn't matter that much is because most people investing in stocks, or even just trading in and out of their positions, usually keep their positions open for at least a few weeks. With that being said, if there are significant movements in the stock price that happens afterwards, either they will not affect the overall picture, so in that case we will cover them the next time we're supposed to cover them, or if they are significant enough that they change the outlooks, then yes, I will do a follow-up video in the shortest delay possible with a reevaluation of what I think should happen next. Progenity is a small-cap company operating in the sector of biotech, and it develops products like molecular testing. Looking at its projects, it feels like what it does is similar to what Bionanogenomics does. They may take a while before they have actual operational cash inflows going in, and in the meantime, they may have to dilute shareholders to keep the ship afloat. We have actually seen this kind of scenario with quite a few other startup companies. This means that at least in the short term, the fundamentals are not going to look pretty for the company. The main reason why Progenity is trending in conversations online is because the company is currently part of a short squeeze between those who want to push the stock price down and those who want to squeeze out the short sellers. It is definitely one of the more volatile stocks in 2021 so far, and hereby provides a lot of opportunities to profit from its ups and downs, in addition to the potential gains from short squeeze. The market cap of Progenity is currently at $800.7 million, and the enterprise value is at $248.9 million. The market cap is the price tag financial market is willing to evaluate Progenity stock at, with consideration to its future potentials as well as the short-term fundamentals. The enterprise value of the company is the net result of the company's assets once all the debts are paid back. Usually the market cap is higher than the enterprise value, but sometimes there may be exceptions because the company may be highly leveraged or the company may be under a lot of pressure from the market, such as large short positions. The quick ratio of Progenity is 0.9. The current ratio is 0.9 as well, and the debt over equity is minus 0.88. The average trading volume of Progenity has been 97 million shares, and the daily volumes have been 122 million shares, 79 million shares, and 221 million shares. The one-year beta of Progenity so far is kind of skewed because it's a new company, but it's far more volatile than the market average. So if you look at the one-year beta, it's currently at minus 0.08. It's obviously not the case. Its 52-week high is $7.86, and the 52-week low is just 66 cents. Let's also talk about the options market for Progenity. In terms of volume and open interest, the options market seems to favor the calls option side. Generally speaking, the put options mean that the market expects a pullback, and the calls options mean that the market expects the prices to move up, and the key strike prices where there seems to be the most interest are $3, $5, and $7.50. Progenity has been one of the more successful short squeeze stocks in 2021 so far, and this is thanks to the perseverance of retail traders ever since the bottom it touched back in September of 2021. On top of that, Progenity recently announced that it managed to reduce significantly the size of its outstanding bonds and has enough cash to conduct its research and development projects for at least the next 12 months. Those are excellent news for the company from a fundamental perspective. Overall, there is no significant adverse developments that occurred to Progenity since the past. Overall, there is no significant adverse developments that occurred to Progenity since the last time we covered the stock. The share price is continuing its upward trend, and hopefully the short squeeze will be successful soon. One thing to note is that we should expect some significant selling pressure from the short sellers at some point, because so far we haven't had any significant ones since September, probably in the form of dark pool short selling that is in bigger volumes than usual. In that case, I would say that we should expect the stock price to retrace by approximately and this is my guts guessing it, by approximately 30% compared to where it is now. I would recommend to maintain a position of 1% of your portfolio in Progenity stock. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.